I think what we're experiencing now is like a minor version of a crack up boom, for lack of a better way to describe it. It's basically that that I think fiscal dominance is probably the cleanest way to describe it, which is that when you have very high public debt levels and then you try to raise interest rates, and it blows out the deficit and is stimulatory when you want it to be restrictive, that's basically this cycle that's really hard to stop. And so not like a crack up boom in like an emerging market or kind of the traditional sense is a lot more extreme. But in the kind of developed market context, that's kind of what we're experiencing right now, and that's not really happened in uh, investors' time frames, like investors' lifetimes in developed countries. It's primarily been an emerging market phenomenon or a phenomenon from war torn countries ages past.
On this episode of the What the Finance podcast, I have the pleasure of welcoming back on Lyn Alden. Lyn is one of the foremost macro strategists, founder of Lyn Alden Investment Strategy, and author of the recently released book Broken Money: Why Our Financial System is Failing Us and How We Can Make It Better. So, Lyn, thanks so much for coming on the podcast today.
Thanks for having me back. Always happy to be here.
No problem. Looking forward to speaking because it's been about 7 months since we spoke last, and a lot has changed since then. So, I guess from your perspective, what are you currently seeing in the macro and liquidity situation?
So I think the biggest macro story is the widening divergence between fiscal policy and monetary policy. That's been a theme I've been focusing on for a while now, and it continues to be kind of the major backdrop that not a lot of market participants, I think, fully grasp because it's been a very, very long time since a market has been in this type of situation. And so what I mean by that is, we take out fiscal policy, that's, what the government's doing. So they're spending into the economy, they're taxing from the economy, they're running deficits. And so how large those deficits are as a percentage of the economy basically refers to fiscal policy. And so they're running unusually large deficits as a percentage of GDP, especially outside of a recession. On the other hand, you have monetary policy, which is things like interest rates and balance sheet by the Federal Reserve, or if it's another country, their central bank. And they're in the United States and most other countries, they're being very tight right now. So they're holding rates fairly high at relatively high periods over the past 20 years or so. They're trying to reduce their balance sheet. And the purpose of that is to try to slow down bank lending and therefore slow down the economy, slow down the demand side of inflation to allow prices to kind of stabilize for a period of time. But the problem is that, when they did that back in, say, the 1970s, right? So back in the 70s, you had very low public debt to GDP. And so when you raise interest rates, you slow down bank lending, which is where most of the inflation was coming from in that period. And you do increase government debt interest rates, which can increase the deficits. But when the debt's so low, that's a much smaller factor than the bank lending. And so it has a net slowing effect. When we fast forward to today with 130% debt to GDP or so, when you raise interest rates dramatically, you result in absolutely massive government interest expense increases, which is it adds to the deficit. And a larger fiscal deficit tends to be nominally stimulative. It depends on what they're spending it on, how really stimulative it might be. But at least while it's happening, that can be quite stimulative. It can be inflationary, it can be pro GDP, nominal GDP growth, and that's being offset by that tightening. But when you get into this period of very high public debts like we're in now, it can be called fiscal dominance, which is that monetary policy begins losing its effect. They run out of ways to slow down the economy because by increasing interest rates, although they do decrease the rate of bank lending, they blow out the government interest expense so much that it's actually the stimulatory forces can equal or exceed the tightening forces that they're doing. And you get kind of in a feedback loop. And that's at the moment, that's what the economy's experiencing. And the result is the bigger divergence between different types of sectors. So, for example, commercial real estate is in shambles. It's doing very poorly. It's very interest rate sensitive. It's very vulnerable to those higher interest rates. But on the other hand, sectors that are not very interest rate sensitive are in general doing pretty great. And so you get that really big gap that's wider than normal market conditions.
Okay, that makes sense. And I know you've mentioned something called the push and pull effects of fiscal and monetary policy. So is that really what you're talking about there?
Yeah, pretty much. You have fiscal monetary policy going the other direction. It's kind of like slamming on the gas pedal while like holding the emergency brake, right? It's just, you get a very weird effect. Then it becomes which one's bigger. And overall, fiscal is bigger, and that's what we're going through right now. At least for the market in aggregate, there are some sectors that are more affected by monetary policy, but overall, fiscal policy is winning. And then, ironically, the key part is that tight monetary policy feeds into more fiscal by increasing the government interest expense, which increases the overall deficits. And there are people and companies on the other side of those deficits, on the receiving side. So, for example, if I have a fixed rate mortgage on my house and I have a bunch of cash equivalents in money markets and T bills and things like that, then the higher the Federal Reserve raises interest rates, my liabilities don't change. Like my monthly interest expense doesn't change, but the income I get from my cash equivalents goes up, and so that I can actually spend more into the economy. And you can imagine there's a lot of upper class, upper middle class, especially older investors, baby boomers, older generations that have quite a bit of cash equivalents and, either no debt or fixed rate debt. And so they're in a very different situation than you'd expect from normal tightening policies. You also see this in corporations. So, for example, um, there are many large profitable companies that have very long-term corporate bonds at low interest rate. That's their liability, and then they have plenty of cash equivalents that their interest rates go up when interest rates go up, and so they're receiving a lot of interest income, and they're able to spend that on acquisitions or dividends or buybacks and things like that, and reward shareholders. And so all of that does trickle into the economy, just maybe not as rapidly as something like stimulus checks, just because of where that income's going, but it is a stimulatory force.
So who's affected? Is it the banks that are really the ones that are having to, I guess, take or I guess offset all this stimulus, as you said, the high interest rates?
So it depends on the bank. Even the banks have divergence. If you're a very large bank, most large banks don't have a ton of commercial real estate exposure. They're facing some pressure from the fact that, in general, they have mortgage loans and things like that on their asset side. So they can be somewhat squeezed, but then it really comes down to the individual bank, right? So larger banks tend to be in more secure condition than like kind of regional banks, and then it comes down to individual banks manage duration better than other ones. So banks that are heavily in commercial real estate, a lot of them are in trouble. Whereas, for example, American Express, they're a bank entity, and they've been doing great, because they don't really have that duration mismatch problem. So yeah, it really depends on the type of financial institution.
Okay, that makes a lot of sense. So, when we last spoke, sort of 7 months ago, you were concerned about the combination of QT and Treasury refilling its cash balance, and you thought that could have a sort of negative impact on liquidity in the markets. It didn't seem to happen. So, I guess is it just the fact that maybe you underestimating, or maybe we just didn't understand the impact that this deficit would have on liquidity in general, or were there sort of other factors involved in this?
Yeah, the main factor was the shortening of treasury durations. And that was one of the possibilities I outlined in a number of my writings around that time. I basically said, here's a problem that's forming, and here's a few different outcomes. And until you know what outcome's going to happen, it's challenging to predict it because these are human decisions. So, for example, what is Janet Yellen going to do? What is Jerome Powell going to do? And so, what they ended up choosing was the treasury shortened their average duration of bonds, right? So instead of issuing long duration bonds, they issued short duration T bills. And what makes that relevant is that there was a $2 trillion build-up reverse repo facility, that money market funds primarily were investing in, and that basically represents available capital, but only for short duration government debt. It can't really be used to buy that longer duration stuff. And so by shortening their average duration, they're able to pull money out of the reverse repo facility and spend it back into the economy. And now they're down to about a quarter of that. So now they're down to about 500 and some billion. So they can't do that forever. But that's been a very long runway of additional liquidity they've been able to push back into the system. And again, this was outlinable in advance, but it's a fairly rare occurrence for the Treasury to shorten their duration this much. and it costs them to do it because that's actually the more expensive part of the curve. So my outline at the time was we have to see what's going to happen here, and it's kind of like how if you're playing a certain game and like you get a little bit more information from the game, like if you're trying to figure out if an item, like with those game shows where there's three doors and there's like an item behind one door and you're trying to get that one. Um, Once they open one door, that gives you more information to make your next decision with. So basically, it was like, okay, be careful. But then once it was clear that the Treasury was shortening T-bills, that's a very kind of overall bullish thing for basically overall stimulatory force. Again, unless you're in one of those sectors that's specifically very sensitive to the monetary policy, like commercial real estate.
And is this the last thing that they could sort of do to, I guess, because at the time there was concerns about the bond markets and I guess long dated, as you said, there was this concern that there'd be lots of long dated bonds sort of sold by the Treasury as well as this, uh, you know, tighter for longer, etc. So is that sort of the last tool that they had to, to increase the liquidity or to help them, or is there anything else?
So that's their biggest tool for the Treasury side. Basically, in autumn of last year, the Treasury market got pretty disorderly. You started to have yields going up pretty dramatically, and around that time is when they shifted towards issuing more debt on the shorter end of the curve. And basically that's their biggest tool that they can pull. Another tool that they're planning on doing is Treasury buybacks, and that's a less potent tool, but it still can improve liquidity a little bit because basically there's when you issue treasuries, there's on the run and off the run securities. And so, for example, back in March 2020 during the COVID crash, the off the run treasuries basically broke. That market kind of went no bid. That's the less liquid part of it. And so with treasury buybacks, they can buy back off the run securities and they can shape their treasury curve a little bit more. So they have a little bit more flexibility. But overall, that's a less big tool than shortening your duration and pulling all that reverse repo back into the facility. So the other main tools are from the Fed, right? So for example, they can go back to quantitative easing, they can do yield curve control. There's all manner of tools that they have available, but they're kind of like a breaking the glass like emergency set of tools because they don't particularly want to resort to pro liquidity things when inflation is still at or above their inflation target.
Yeah, that makes sense. So I guess from what it sounds like, the liquidity situation is quite good. Where as we see, markets are all-time highs. There are sort of it seems to be a correlation between the two. Where do you sort of see them in the future? Or I guess what are the scenarios is probably a better question.
Yeah, so back in the prior scenarios, basically, okay, what happens when the Treasury runs into liquidity problems? And the answer was shorten the duration. The next big kind of if else decision point will be what happens when the reverse repo facility gets very low or runs out, which is not right around the corner, but it can happen later this year. And Treasury Fed officials have already talked about that. They talked about the possibility of slowing down their QT eventually in response to the reverse repo facility getting fairly small. That's when you could see, I think the biggest comparison would be September 2019, which was the repo rate spike. That was a macro event that was not very noticeable to retail investors, but that was kind of a big event for macro oriented investors. And it basically signaled the end of the prior quantitative tightening by the Fed, and they had to go back to some degree of quantitative easing to help with overall liquidity. So I think you could see a similar pivot like that um, whenever that gets low. But as it gets low, that becomes something to watch fairly closely. Overall, I think most economic indicators are now showing early signs of reacceleration. I would say largely it's fiscal driven, but there's still some troubling spots. So commercial real estate, unemployment's kind of in a mixed situation right now. Some of the global economies are still kind of stagnating. So I think we're in early signs of potential reacceleration. We have to watch to see if it's sustained, and then the next big thing to watch is what happens when the reverse repo facility gets fairly low. And you can kind of reduce the drama by not being in long duration treasuries, right? So, if you want to take on risk, there's plenty of other ways to take on risk. Um, and if you want to be in risk off, or at least have part of your portfolio in risk off, then, things like short duration treasuries or treasury inflation protected securities or other types of defensive assets can largely sidestep the question of what happens when the reverse repo facility gets low or runs out.
Yeah, that makes sense. So you think it could potentially have an impact, but I guess we'll have to wait and see what other tools they use.
Yeah, they can always pull out more tools, but I think in general, a fairly large moment would be when the Fed is no longer able to tighten their balance sheet anymore. They can still at that point, if they want to keep interest rates high, but then arguably high interest rates plus no more QT or outright QE would be stimulatory. And so we have to see what how they decide to navigate that. We have to see what's happening with energy markets at that time because that's obviously a very important input into overall inflation. So that's kind of the next overall set of things to watch.
Could you see them potentially reducing interest rates while continuing with QT?
Certainly in the intermediate term, that might be something that they do this year. They're already openly discussing the possibility of reducing interest rates. That's in large part because official measures of inflation have decreased a little bit. So if they want to, if you want to, let's say you wanted to maintain positive 2% real rates, and you have inflation going down, you can then reduce nominal interest rates while still staying, say, 2% above official CPI, just as throwing out kind of round numbers. So they certainly have that option. Um, but some of the liquidity dynamics are less sensitive about interest rates and more about just the sheer amount of treasuries coming to market compared to available capital to buy them. Lower interest rates can allow some entities to buy them. For example, can ease banks a little bit, and that they could, something could go back to buying some treasuries, which they're not really doing right now. But overall, I think the balance sheet side is a little bit bigger for macro. And primarily where the interest rates matter is some of those really interest rate sensitive industries. So commercial real estate, especially, unprofitable tech companies that rely on kind of a lot of equity issuance and things like that. And then to less extent, residential real estate, not necessarily in terms of prices, but in terms of just overall volume, like how many transactions are happening. And there are a lot of businesses obviously based on how many homes are sold versus what the prices of those homes are. So there's certainly some sectors where that really matters.
Yeah, no, that makes sense. So if we link it to what's happening in the markets at the moment, I mentioned that it's at all-time highs. It's recently broken 5,000. What do you think? Is this due to liquidity, or do you think there's other factors sort of influencing this?
So I think part of it's liquidity. I think part of it is I think we're in a high period of I wouldn't call it euphoria, but certainly some areas are euphoria. And it's basically it's also a view like a lot of investors don't know where else to go. They're like, oh, I'm not going to go to Europe and invest. I'm not going to invest in China. I'm not going to invest in emerging markets. And so they kind of just stick to quality. I think there's a little bit of a bubble in, ironically, high quality US stocks. So, for example, Costco, great company, but they're trading at like 45 times earnings or something like that. And it's a 40-year-old, retail wholesaler. And again, they're doing great. But, in most market conditions, 45 times earnings would not be the appropriate level for that. There's a lot of stocks like that, and so I think that there's multiple factors going into that. I would, despite the fact that I see signs of economic reacceleration, despite the fact that I kind of view the fiscal backdrop as like basically a slow motion crack up boom, I would still be very careful with individual overvalued equities, ones that there's a lot of euphoria baked into. It doesn't mean they have to go down. They could at some point go sideways for a long period of time and fundamentals catch up. But basically, if you want to optimize risk and returns, you want to be careful of things that are already heavily overbought, heavily leaned into by capital, and focus on things that are doing well fundamentally, but don't necessarily have that big valuation bubble attached to them.
Okay, and what assets would you say that those are?
I think that, I mean, so for example, I think if you want to be in that bullish kind of tech area. I mean, I'm structurally bullish on Bitcoin still. Today it's been kind of bumping around 50,000. And there's kind of maybe some local excitement about it, but I don't think it's really widespread yet. And I have no particular view on what it does for the next 3 to 6 months, but I'm structurally bullish for multi-year view. For some kind of like lower volatility areas, I mean, I generally still find the energy complex pretty interesting. It's profitable in general. It's many of the balance sheets are pretty good. It's not expensive, and so you basically have this like long-term positive carry exposure to the risk of higher energy prices in the future, and you get paid to wait. That's what I mean by positive carry. So I think that's a decent, kind of a different type of position. I find select emerging markets interesting. So Latin America, for example, certain parts of Southeast Asia, we could see a China equity market pivoting to some extent, but investors have to be somewhat careful about geopolitical issues like tail risks that could occur. Kind of like how if investors were exposed to Russia, the war happens, and then they basically get all their assets sanctioned, and the company is still there. Just your claims of them are contested. So there's tail risks, things like that could happen to China. But basically, wherever capital's not heavily exposed to right now, but that still has decent fundamentals, I think are fairly interesting. I think that there's um, some of the kind of, if you look at, for example, the S&P 500, the normal one is market weight. There's an equal weight version, which sometimes outperforms and sometimes underperforms. If we do get a period of sustained economic reacceleration, then that equal weight one, which did way worse than the market weight one last year, could play a little bit of catch up. So there are many equities out there, either domestically or foreign, that are not that expensive. Even as other ones are. There's kind of a bigger than normal valuation gap between different types of equities. And so that's kind of how I'm viewing it. When I take on volatility, my preferred way to express it is Bitcoin and certain other select equities. And when I want to be defensive, it's things like short duration T bills, it's tips, it's gold, it's certain defensive sectors.
Yeah, it makes sense. Did you mean was it a crack up boom that you were saying before that you think maybe not now, but we could experience it in the future?
I think what we're experiencing now is like a minor version of a crack up boom, for lack of a better way to describe it. It's basically that that I think fiscal dominance is probably the cleanest way to describe it, which is that when you have very high public debt levels and then you try to raise interest rates, and it blows out the deficit and is stimulatory when you want it to be restrictive, that's basically this cycle that's really hard to stop. And so not like a crack up boom in like an emerging market or kind of the traditional sense is a lot more extreme. But in the kind of developed market context, that's kind of what we're experiencing right now, and that's not really happened in uh, investors' time frames, like investors' lifetimes in developed countries. It's primarily been an emerging market phenomenon or a phenomenon from war torn countries ages past.
Can the US continue with the deficits that it's currently running, or do you think there's going to get to the point where it's going to run out of these tools to sort of help the currency and to protect it?
So I think the most likely outcome is that the deficit will continue for the foreseeable future, but that monetary policy will have to change a little bit to eventually facilitate that. So that could be things like the Fed ending QT and going back to gradual QE. It could include changes to the SLR rules so that banks can buy more treasuries. It can include things like that. I think that, yeah, I think overall this is going to be an environment that persists for a fairly long period of time, and there are still cycles within that. So, for example, if in some ways the more like say the more that things like AI or other deflationary forces um, are impactful, they allow basically the Treasury and the Fed to kind of get away with more of this because it doesn't necessarily show up in CPI. Things that are inflating are being offset by things that are deflating. On the other hand, if you have that technology and that type of thing not be as deflationary as quickly as some people think it is, or if you get other inflationary factors, like for example, higher energy prices, structurally higher energy prices. Maybe it's because supply goes offline due to some sort of disruption, which these days is not out of the realm of possibility, or just general capex. If these stimulatory forces result in more energy demand over time, and there's not a lot of capex going into it, you could get another significant energy bull market that spurs more capex eventually, and that can really pressure these types of systems. So I think that probably energy and tech deflation are the two areas to watch to see how long this current regime can last without kind of major structural changes. But I think in the next couple of years, I think the thing to watch is, does the Federal Reserve end up having to do pro liquidity actions when they don't want to, right? That's kind of the big signpost to watch, in my opinion.
Okay. Do you think the US economy could it last with austerity, or would it sort of just disintegrate?
I think there's two factors to that. I think that there's no political will to do austerity. So regardless of whether it could last or not, I think that it's very unlikely. You have a very split Congress. So you have very adamant side, very strong side that would be against any sort of major tax increases. You'd have another side, in fact, both sides would really be against any sort of major spending cuts. Kind of the third rail of American politics is don't touch Social Security or Medicare, especially because that's where the majority of the voters are. Um, and so there's very little will to do that, first of all. Secondarily, I think that you'd have a major issue even if you tried at this point because the economy is so financialized, and so it when the economy is not financialized, equities generally should follow what the economy is doing. So if the economy is doing well, profits are good, valuations can rise a little bit, stocks should do pretty well. If the economy is weak, profits are going to be worse, valuations are going to, probably suffer somewhat, and the stocks are going to go down. But because we're so financialized, there's so much net worth stuffed into equities. And then in particular, what makes America different than many other countries is a lot of our equity, a lot of our executive compensation. One is we're very wealth concentrated compared to most, say, European countries or compared to Japan. So a lot of our wealth is in the top 5%, 1%, 0.1%, and a lot of their compensation is tied to equity, which means when equity prices are higher, they have more compensation, which they can spend into the economy. And so you actually get a situation where and then they pay taxes on that. So, for example, lower stock prices tend to result in lower tax revenue or a decline in the rate of change of tax revenue, which results in even larger deficits. So I think if they were to try austerity, which yeah, good luck getting that through any sort of political will. But if they were to try that, you probably would have a scenario where, say, they cut spending, but then also revenue kind of stagnates as well, so the deficits stay just as big or larger. So I think it would take a pretty miraculous change to get off of this course. I've been the meme I've been doing a lot on social media is Walter White. Nothing stops this train, because it's so solidly kind of in action, that until I see something absolutely enormous change its course, I think that's the structural direction it's on. That doesn't mean that any given quarter, any given year, you could have fluctuations, cycles within that trend, but that is the long-term story. And then the secondary question is to determine to what extent all of that debasement, all of that kind of fiscal dominance, either flows into CPI, likely due to things like energy shortages, or if it flows into asset prices, which is generally what is likely to happen if you don't get energy shortages and or you get a lot of like AI tech deflation and that kind of thing.
So I guess that would be comparing like the 2010s versus the past few years that we've experienced, whether, what scenario does it go down?
Yeah, exactly. And that's why I think energy is a very useful hedge because it's one and higher energy prices is one of the major risk factors for non-energy equities. And so in this type of environment, sometimes energy equities or energy things like that can be a better protection against your other equities than long duration bonds can be. So in 40 years, generally stocks and bonds were inversely correlated, but during periods of, say, higher average inflation, things like energy stocks tend to be a better hedge for those other assets that generally prefer, you know, tech-driven disinflation. Like high multiple growth equities, for example, they generally prefer low CPI, low interest rates, everything's rosy. That's how, and like large deficits because then they can keep just grinding higher. But if that does show up in higher energy prices, higher CPI, that requires the Fed to try to be tighter. That results in more political polarization, more risks for kind of issues. And so I like that barbell approach of some assets very much benefit from tech deflation and just overall currency debasement, and then other ones that are generally benefit more from that stagflationary type of environment. So energy price disruptions or growth against insufficient capex and things like that.
Yeah, okay, no, that makes sense. So you've talked about there before if the Fed sort of forced into, I guess, loosening when they don't want to, and you've also mentioned there's potential for debasement with current deficits continuing. I think this links quite well to your book, and I guess the title, "Why Our Financial System is Failing Us." So I don't know if you want to go into more on that and ask, yeah, just answer why it is failing us.
Sure, and I think there's two sides. Like there's two different areas. So in developed countries, like we've just been talking about, it's primarily a question of debt, debasement, where the money goes. And if you look at the other side, which is like developing countries, they often have a lot more extreme events. I mean, I spend part of each year in Egypt, and they're currently experiencing a currency crisis. And so they have over 30% inflation. Their currency has lost a tremendous amount of value compared to the dollar, even as the dollar itself has been debased. And that's happening in dozens of countries around the world. And so the a big theme that I cover in Broken Money is that this was largely a technological phenomenon. So ever since, if you go back to kind of the full history of banking, mostly what you're trying to do is make money more efficient. So gold is costly to move around, it's costly to verify, it's slow, and so most of the history of banking was how can we move this faster by moving it as little as possible. So, for example, you deposit gold in a third party, and then if me and you are both using the same party, and I want to send money to you or you want to send money to me, we just contact that third party and say debit from this account, add to this account. And that just represents our claims of that gold moving, and that trusted third party just keeps holding the gold. That way, the gold has to move and get verified less often. That's kind of the multi-century history of banking for the most part. And whenever that kind of blows up, you add another layer of centralization. You kind of just built centralization on top of centralization on top of centralization. And what really kind of kicked into high gear was the introduction of the telegraph. And so that was invented in the 1830s, but it wasn't really widely deployed until the 1860s. So cross continent, cross Atlantic Ocean, connecting the Western world. By the early 19th century, it crossed the Pacific. It kind of connected the rest of the world over time. And by that point, we could move transactions at the speed of light around the world. But of course, we still couldn't move the physical settlement. And so over time, this fractured into increasingly centralized systems. They dropped gold backing entirely, and there's not really been a viable alternative for that time. And so we kind of find ourselves in a world where there's 160 different fiat currencies or so. Most of them rapidly lose value. A handful of the best ones lose value slowly. Most of the other ones are not wanted anywhere outside of their jurisdiction, right? So, for example, I have Egyptian pounds and Norwegian kroner in the drawer next to me, and there's very little way to spend them here in New Jersey. There's even converting them to other assets. There's very little uh, liquidity for that. They basically lose all of their monetary properties outside of their jurisdiction in a similar way that arcade tokens or casino chips lose value outside of their very narrow defined, kind of issuer regions. Um, and there's only a handful of kind of global assets that connect that all together. And so one of the contentions I make in the book is that, even though the broader crypto space has been filled with hype and fraud and scams and things like that, that Bitcoin and some of the underlying technology and things like stable coins are actually powerful innovations that are solving problems and that are probably going to surprise a lot of people to the upside in the years ahead in terms of what their staying power is like and what they end up changing.
No, it makes sense. And then do you see, I guess the risk of centralization and the CBDC is a classic thing that a lot of people talk about. Do you think that's something the governments are going to try to do sort of bring it into the Fed and their own control?
I think that's the big fork in the road. I think that, CBDCs are basically the capstone on the multiple centuries of centralization that I just talked about, right? So that's the final thing. That's basically that the government can monitor every transaction that happens, freeze any transaction they don't like. That's kind of the end state from the centralization perspective. But on the other hand, we have for the first time in history, we have ways to do distributed settlement, ledgers that are backed up by energy in a decentralized manner rather than just tied to like one central bank's ledger. And so we kind of for the first time have the ability to do speed without centralization. Whereas for centuries, almost every friction in money is solved by centralization. You say, okay, we'll just make this friction go away by centralizing it. We'll just use the shared ledger. And then when that has frictions between like another shared ledger, we say, okay, we'll build a bigger ledger under them. We'll make it a central bank. And when central banks have trouble, kind of connecting with each other, they resort to connecting it into an even bigger central bank. So the world reserve currency it used to be Britain, now it's the United States. Almost every problem is solved by centralization. But with this technology, as long as humanity has the internet and other high bandwidth manners of communication, which they've had for a long time now, there's ways to do this in a more distributed manner. And so I think that technology is going to be very powerful. And we've kind of seen interesting scenarios where, for example, in Nigeria, they have ongoing long-term currency crisis, high inflation, persistently high inflation, and so they also have a fairly tech-savvy population, especially in cities there, and so you had very high adoption of things like Bitcoin and stablecoins. And so the central bank said, well, okay, we're going to block all banks from sending money to crypto exchanges to try to slow this down, and we're going to introduce a CBDC. And what happened was that ban was in place for something like 3 years. Nigeria, by most metrics, for example, Chain Analysis estimated that they had the second highest crypto adoption in the world, and specifically the highest peer-to-peer trading volumes in the world, because that's how they went around those bank blockages. So they failed to slow down, Bitcoin, stablecoin, and sometimes other crypto use cases or speculation. At the same time, their CBDC had very low and slow adoption. No one really wanted it. It wasn't really solving a problem that people wanted. And in recent months, the central bank has actually reversed their prior ban. It's kind of acknowledging that it was not working, and instead they're saying, "Well, let's instead try to regulate this because it's not working." And I think that's kind of a theme we're going to see a while. Is that central bank digital currencies, they don't really solve a lot of problems that people are looking to solve, and so I think we're probably going to see an ongoing battle between what policymakers want to happen and what the people find actually kind of serves their needs better.
Yeah, no, that's really interesting what you're saying there about Nigeria. And as you said, it's one of those things that even if they can try and prevent it, there's the peer-to-peer system, which is possible. An interesting thought: if we do see maybe an energy crisis or higher energy costs, or maybe even the opposite, where energy becomes extremely cheap, what impact will these things have on blockchains?
Um, Not that much because for example, Bitcoin has a difficulty adjustment associated with it. So for example, if energy costs spike and the price of Bitcoin does not, then the weakest miners go bankrupt or stop mining. And then the network checks every 2 weeks what is the average rate of block production, which depends on how many miners are on the network. And then if miners have fallen off the network, then it makes block production easier. It basically calibrates to the number of miners that are currently on. And so energy, it's in and of itself does not really directly impact miners. The indirect thing is that governments can use that as a narrative because governments don't particularly like the fact that things like Bitcoin exist. And so if you get energy price spikes, then you get things like, governments blaming Bitcoin for it or trying to say we have to push Bitcoin out of our jurisdiction. And so it really can kind of move around where the Bitcoin miners are, to determine kind of how difficult it is to operate a mining business. But for the most part, it doesn't really affect the blockchains themselves because that's been taken into account by the design. In fact, that's arguably Satoshi's main addition. Because when you put Bitcoin together, there are a bunch of things that already existed. He didn't invent blockchains. He did not invent proof of work. He didn't invent the types of encryptions that he used. But he put it all together, and then he added the automatic difficulty adjustment, which is kind of the control mechanism, the automatic control mechanism that makes it work. Because if you tie money creation to processing power, then as processing power increases exponentially, it would eventually inflate the currency. It would result in quicker block time generation than expected, and therefore more coin issuance than expected. And so having that difficult adjustment in there makes it so that even as processing power keeps increasing, it does not result in faster block times. And even as you get, say, higher or lower energy prices, the network adjusts for that as well.
Okay, no, that makes sense. Thanks. And then I guess famous question: what is your outlook for Bitcoin and I guess cryptocurrencies in 2024? Do you have a sort of any biases?
We've already hit some of the targets. I have a very big range for what I expected to go to. I've been trying to stick to like a 2-year view because I don't really know for sure what's going to happen in 2024. I have higher conviction that throughout the course of 2024 and 2025, it'll be notably higher than it is now. That's kind of my overall base case. I'd be surprised if we didn't see six figures in that 2-year view. Certainly possible that we won't, but I'd be surprised if we would not. And from there, there's a very big range because you're basically you'd be trying to predict what do humans do when the price goes up. Well, how much of them will buy? I don't know. But basically, we know the supply side. We can also look at on-chain indicators to see, for example, the behaviors on the supply side. So you can look at how many coins are held by entities that have a very low propensity to sell. And during bear markets, that ratio goes up. The people that have been buying coins in the bear market that have gone through a lot of that, they're generally not going to sell anytime soon, even with a significant bull run. It would take a very high price point to get those coins out of their hands. On the other hand, when you have bull markets, you have a lot of new buyers coming in. Generally, that's the handful of times when those longer term holders tend to sell. They sell into that strength. We've not really seen that cycle start yet. And so I still think we're fairly early phase in the bull market. But that doesn't mean anything about 3 months or 6 months. Um, Generally, my research shows that Bitcoin price is heavily correlated with liquidity in any given multi-month period, generally speaking. And so, kind of the stuff we talked about earlier in the conversation. What happens when the reverse repo facility gets low? What are some of the liquidity actions that they can resort how bad would they let liquidity get before they were forced to intervene? Those types of things can all determine what Bitcoin does in any sort of given quarter or couple quarters. But long term, next 2 years and longer, I'm quite bullish.
Okay, that makes sense. And I guess if we look at the liquidity situation with the reverse repo, would you say that's probably 3 to 6 months? I guess it's hard to predict, but that's probably how long it will last.
I think that's a reasonable time frame. It depends on a number of factors. So the Treasury general account is no longer increasing, so that's not really sucking any liquidity out of the system. And so overall, I think you still have another quarter or two, or potentially longer of reverse repos. And then we'll see, does the Fed, I guess the main choice is to see if the Fed kind of preemptively adjusts to that, or if they wait until there's a liquidity event and then jumps into it. So if there's a liquidity event, you can certainly see a down move in any sort of high volatility assets. But I'd probably be a buyer of those types of dips for assets that I like.
Yeah, that makes sense. So, Lynn, thanks so much for your time today. I really appreciate it. My last question: what is one message you'd like people to take away from our conversation?
I would say study the dynamics of fiscal dominance and periods of history where fiscal policy and monetary policy diverge. A lot of people get caught up in um, kind of recency bias. So what happened over the past 10, 20, 30 years? And it's just a fairly different macro environment than that. Or to the extent that we look in more modern times, you have to kind of look at emerging markets to see some similar types of environments. So it's a very unusual macro environment by statistical standards. And I don't necessarily expect that to end anytime soon. And so I think it's worth understanding if a lot of what I said here was complicated, or we covered a lot of subjects in a short period of time, I talked very quickly. Um, but if those things are interesting or you didn't understand certain things, I would say that they're really worth looking into, just because I think that's one of the key defining macro variables in this time period, along with the other things like AI, energy security, things like that. But that kind of fiscal dominance is something really worth studying.
Yeah, it's a good point. As you said, it's going to definitely be looks like it's going to be a trend for the future. So yeah, thanks so much for your time. I really appreciate it. If anyone wanted to find out more about your work and what you do, where would the best places for that be?
So they can go to lynalden.com. I have a free newsletter. They can check out public articles, and then I would also recommend, look up Broken Money. It's my book. A lot of people have been liking it. I wrote it for a pretty wide audience, even though it's long. It's modular and accessible, I think that's the main way I'd point people.
Yeah, perfect. I'll put a link in the description below if anyone wants to buy the book. I haven't had the pleasure of reading it yet, but I'm looking. It's on my list. One of the ones that I want to get to. But yeah, Lyn, thanks again for your time.
Thank you.